think the best summary is that we seem rapidly to be moving from a risk of an economic crisis to a risk of a financial crisis. That basically means that everything is worse than most people think and worse than risk assets are pricing in. What I want to do today is to explain why that's the case. The main reason things are worse is that specifically because of Trump's policies, we are transitioning away from what had been a win-win situation in which the whole world benefited and financial markets went up and the US came out on top to what risks becoming a lose-lose environment where the whole world suffers, financial markets go down, and the risk is that the US suffers more. But critically, it also feels to me as though we are getting close to one of these moments that I've seen several times in my career, where the price action in one corner of financial markets basically dominates everything else. Let me try and explain how the pieces fit together and how best to navigate it. To do that, as usual, I've divided the presentation into three. We'll start with the tariffs, obviously, and I'm going to argue that even with the pause and with the recent sell-off, they're still significantly worse than either consensus or markets are reflecting. And we'll also look briefly at some of the recent price dynamics. Then I'm going to turn to just why the tariffs are so mistaken and so damaging. Not only are they badly implemented, not only are they not going to achieve what they're designed to and fix the problem they're designed to, but worse than that, the whole zero-sum mindset they rest on strikes at the processes which have made both the US and the world wealthy and made markets go up. And then lastly, I'll look in more detail at the outlook, at why the risk of financial crisis is growing so rapidly, and at which markets you're supposed to be looking at to assess the damage. This presentation also has a large appendix. I'm not going to run through that, but you can get me to come back to it in the Q&A. But if there's one thing that I hope I can achieve in the next 30 minutes or so, it's to convince you that what Trump is really doing here is attacking trust in the system itself. That strikes at the heart of the economy, at the heart of financial markets, and at the heart of everything that has made America great. And it does so in ways which are going to be hard to repair, even if he now tries to back down. And frankly, it makes me surprised that markets have not moved even more already. So let's start with the tariffs. Basically, it's hard to be rude enough about them, though many analysts have tried. So there's the formula that was initially denied and then admitted to. There's the way that they punish remote islands for no obvious reason. And my favorite being the Falkland Islands. The UK gets 10%, but if it's the Falkland Island, it gets 42%. There's the way that Russia is mysteriously excluded. And of course, now there's the way in which less than a week after they were introduced, they're temporarily reduced to a blanket 10% for 90 days. But I think the key thing for you here is on the right-hand side. Most analysts estimate that even with the postponement, the increase to well over 100% for China, even with some rebalancing, basically will lead to an average combined tariff of about 25% or so. That's back to what we had with Smoot-Hawley and the 1930s. But of course, trade now, even for a relatively closed economy like the US, is 3 times the volume of trade that it was back then. And that implies a substantially larger hit to the economy. In addition, if there's anyone still left thinking that, well, tariffs weren't that bad under Trump the first time round, remember that last time round, much of the effect on the US consumer was offset by the dollar appreciating. And this time we seem to have the dollar depreciating. That's extremely important, and I'm going to come back to it later, but of course it makes the inflationary impact worse. The irony here is that there probably is a right way to use tariffs, it's just that Trump isn't doing it. So if, for example, you have strategic concerns for military reasons, given your geopolitical rivals, then fine, you can use small-scale targeted tariffs on certain industries and on certain geographies. But of course, that's not what Trump is doing at all. In addition, It's really important that there is clarity and certainty around the framework so that businesses can plan. But as some of you may remember, sort of what I said at the start of the year is rule number one in the court of King Donald is that everything needs to revolve around the Donald. That means everything needs to be hugely uncertain, as we can now see on again, off again. But that makes life impossible for businesses. So economists everywhere are busy modeling the impact. I don't do this directly myself. A lot depends on how trade is diverted and the numbers keep changing the whole time. But roughly as things stand, especially after the first 90 days, it's especially bad for small open economies in Asia. Latin America does a little bit well or relatively well by comparison. But the whole thing looks more like an extortion racket run by a bully than a carefully designed plan by the leader of the free world. Now, it's going to take a bit longer for this to show up in the economic data and even in the surveys, but you can already begin to see some of the stories coming in about Amazon turning around ships in the mid-Pacific and so on and cancelling orders in China. And I think it's interesting to note that even prior to all of this, actually US investment had been plateauing. There had been a real pickup, mostly thanks to the CHIPS Act in computing-related industries, but that was already plateauing. And all the signs are that this is going to get significantly worse. So yes, you have Novartis and Intel and other companies engaging in these $5 trillion of investment that Trump has talked about or promising that, but it's mostly over extended periods of time. A lot of it was going to happen already. And I think a lot of it will be put on hold until there is more clarity about where the tariffs are going. Commerce needs a stable environment, and a stable environment is exactly what we're not getting. So no one quite knows how big the impact on GDP and inflation is going to be. It's very clearly stagflationary. It's negative for growth. It's positive for consumer prices, especially in the US. But I think all the signs are that the hit is going to be larger than is reflected in consensus at the moment. Now, some of that is just the natural way that consensus lags, but most of the estimates from economists that I respect suggest a hit to US GDP of at least 1.5%, expect inflation to rise to probably about 4% or so. But if anything, my bias is that the hit will be even larger than this on both directions, basically for four reasons. So first, there's Wall Street's traditional reluctance to forecast recession. Second, there's the comment I made earlier about how more deeply integrated everything is relative to the 1930s. Third, there's that weakening of the dollar that makes the inflationary impact worse for the US in particular, although it will reduce it somewhat elsewhere, especially in Europe at the moment. And then finally, and maybe most importantly, I think there's a strong argument that financial markets now are much more important for the growth outlook than they were previously, especially in the US. And as we're starting to see, markets are doing horribly. So that, for me, is the backdrop when I keep looking at my screen and being mesmerized by the price action. And while the moves are large, they're still not that large compared with the sort of shocks that I've just been describing, never mind the financial ones that we'll come onto. You have to remember that when we started, we had really elevated equity valuations, and even credit spreads, again, were very close to all-time tights. There's just not much cushion there. And despite the surges in trading volumes that we've had, I'm not convinced we'll see presently that positions have really changed. Now, obviously, in the last day or two, everyone's got very excited about hedge fund unwinds and basis trades and swap spread moves. And there clearly is a lot going on here in response to margin calls. But I'm not sure that while that's exacerbated the price action in treasuries and especially in swap spreads, I'm not convinced that that's responsible in a broader sense. It is true that the basis trades in particular are quite big. You've got about $800 billion worth, and that will have exacerbated some of the price action. But I don't see anything systemic going on. I don't see anything particularly disturbing in repo market levels. You're seeing some of the spread spike, but it's kind of less than you would get on a normal quarter end. Certainly nothing you would associate with financial crisis. Treasury on the run, off the run spreads, again, have been relatively well behaved. So I don't think that that's the big story here beyond the pain for a few individual hedge funds. It is true that there's been a big surge in hedge fund leverage in recent years, especially at multi-strat funds. And a lot of what's going on there is direct repo financing by money market funds. Paul Davies had a nice story on Bloomberg. And I do think that's interesting. It's something that regulators may want to look at in future. But I've argued a lot over the last decade, and I would still argue now, that the real risk is not there. It's the way that long-only investors have been herded into momentum chasing and buying the dip, basically by asymmetric central bank policy, and that anyone focused on relative value or outright value or shorting things, basically they've been forced out of business. Over the past year alone, there's been more than $1 trillion in what I call kind of excess inflows to mutual funds and ETFs beyond what I can explain using central bank liquidity. And over the last decade, I think that the central bank liquidity has pushed in many trillions more, which are now at risk of coming out. So just yesterday, we started seeing the stories about large outflows from leveraged loan funds, from high yield funds, from equity funds. I think you will see much more of that. If anything, it's amazing how small the outflows have been to date relative to the sheer size that had gone in there previously. Right, that was exhausting, and that was just the events of the past week. Let's try to explain a little as to why the tariffs are so misguided, why it's so damaging, and yet why it's likely to continue or even accelerate.